imagine you are sitting down to play just the highest stakes game of chess of your entire life.
Oh, okay, I'm picturing it.
Right, so your opponent is sitting across the board, their hand is hovering over the pieces. But, and here is the catch, you are not allowed to actually look at the board as it exists right now.
Oh, wow.
Yeah, you are only allowed to see a photograph of where the pieces were, say, 3 moves ago. And if you want to survive, I mean, you have to extrapolate their current strategy based entirely on their past behavior.
Which is essentially a guaranteed way to lose the game. I mean, if they change tactics, you wouldn't know until it's way too late.
Exactly.
Wow.
And yet, when you step into the world of global financial risk, that is exactly how we are playing the game right now.
Yeah, unfortunately.
Welcome to the Deep Dive. We are incredibly glad to have you sitting at the table with us today because, well, we want you to think of yourself as the third executive in the room for a closed-door, really high-level strategic roundtable.
Yeah, pull up a chair.
Our mission today is to conduct a critical board-level review regarding long-term organizational resilience. The documents we are analyzing, they include internal corporate strategy roadmaps, product architecture descriptions, and this really fascinating executive intelligence report from a risk analytics company called Sophurion.
And to properly dissect this source material, we are approaching it through 2 very distinct executive lenses. So my background aligns with a senior insurance executive, meaning I'm looking at this data through the lens of underwriting, enterprise risk management, and, well, pricing risk accurately.
Right, the actuarial side.
Exactly. I am specifically interested in what happens when the actuarial models we've relied on for decades just begin to fundamentally fracture.
And my perspective aligns with the global bank's chief risk officer. So I'm focused on the lending portfolio, capital allocation, and really just ensuring that our bank doesn't step on a systemic financial landmine.
Which brings us to the central paradox, right? The one sitting right at the top of our agenda today.
Yeah, the texts highlight this staggering reality. 90% of all the data in the world was created in the last 2 years alone. I mean, we have petabytes of data flowing through our servers every single day.
It's massive.
It is. Yet, financial institutions are struggling more than ever to make confident strategic decisions.
It is the ultimate diagnostic blind spot. I mean, the sheer volume of information has not equated to executive clarity at all. In fact, clarity has actually decreased as the noise has increased.
Okay, let's unpack this. Because before we evaluate any of the, the technological solutions proposed in our briefing, we have to understand the mechanical failure of our current systems.
Right. Why is everything breaking down?
Exactly. Why are traditional risk management models under such massive pressure right now? Because from a lending perspective, when I look at traditional enterprise risk software, I see platforms that are heavily indexed on governance, compliance, and, well, historical incident tracking.
Yeah, they are incredibly good at documenting what has already happened.
Right. But relying on that for future resilience is like trying to navigate a modern chaotic megacity using a paper map printed in, 1995.
That's a great analogy.
The map shows you where the roads were built, sure, but it tells you absolutely nothing about the live traffic cam, the sudden construction detour, or the bridge that literally just washed out.
And the terrain we are navigating today is, it's entirely unprecedented. The sources actually define this new terrain as the age of convergence.
The age of convergence.
Yeah, so for 50 years, a large enterprise could just compartmentalize its threats. We treated risks like separate biological specimens kept in sterile little jars.
Right, so environmental concerns went to the sustainability team.
Exactly. Supply chain disruptions were handled by procurement. Geopolitical tension was strictly monitored by corporate security.
They were just completely siloed disciplines. But the texts argue that model is dead.
Completely dead. Today, what we are witnessing is the simultaneous convergence of climate volatility, geopolitical instability, cyber warfare, macroeconomic fragility.
It's a lot.
It is. And rapid regulatory shifts all at once. They are no longer isolated variables. They're a complex system of interconnected nodes.
Okay, give me a concrete example of how that actually cascades in practice. Because interconnected nodes can sound a bit, academic. How does this actually hit the balance sheet?
What's fascinating here is how fast it moves. Let's trace a realistic shockwave based on the frameworks in our source material. So imagine a localized geopolitical tension flares up in Southeast Asia, involving a naval blockade.
Right.
Within 24 hours, that tension triggers a spike in global energy markets. That immediate energy shock creates downstream inflationary pressures all across Europe.
Right.
And that inflation forces central banks to suddenly alter their interest rate strategies.
Which fundamentally alters my bank's lending environment and our investment decisions.
Exactly. And simultaneously, that initial naval blockade disrupts the export of critical semiconductor components.
Oh, the microchips.
Right. So now, global auto manufacturers have to halt production entirely, which means your bank's massive auto loan portfolio is suddenly exposed to a severe inventory crisis.
While your insurance firm is simultaneously hit with business interruption claims from suppliers caught in the crossfire.
Exactly. One localized event mutating across 5 different risk domains.
And this exposes the core issue the sources call the global intelligence gap. Both of our industries, banking and insurance, we struggle to identify these emerging threats before they become material, balance sheet destroying events.
Yeah, we're always reacting.
And the texts make a vital distinction here. The problem is not a lack of data. I mean, the data about the naval blockade, the microchips, the interest rates, it exists. The problem is that it's entirely fragmented.
The cybersecurity team has their own proprietary dashboard. The procurement team uses a different supply chain management software.
The financial planners are locked into their ERP systems.
Right. The data is trapped in isolated silos. What's missing is the synthesized intelligence. The mechanism that automatically connects a geopolitical flare-up to a specific vulnerability in your Tier 3 supply chain.
Which brings us to a perfect test case. If you're analyzing this material with us, let's move from the theoretical concept of convergence to the most pressing, undeniable example outlined in our source stack, which is climate-related disruption.
This is a massive one.
It is. Now, a quick but really important note for you listening. The topics of ESG, sustainability mandates, and climate regulations, they are highly debated in political and financial circles right now.
Definitely.
And our goal today isn't to take a stance on those political debates. Rather, we are looking impartially at exactly how these source documents view climate volatility strictly as a mathematical and strategic business risk.
And if we connect this to the bigger picture, the texts warn against treating climate solely as a compliance exercise. It is no longer just about printing a glossy sustainability report to make people happy. It is a hard systemic business risk. It directly affects physical infrastructure, resource constraints, and operational continuity.
But let me push back on how we actually measure that.
Yeah.
Because from a chief risk officer's perspective, I can measure a credit default. I can measure a liquidity crisis. How do you mathematically quantify something as broad and atmospheric as climate change before it actually hits a client's revenue stream?
By looking at the baseline volatility, which is fundamentally altering actuarial science right now, historically in the insurance sector, we have relied on decades, sometimes centuries, of historical claims data to price our risk.
Right, looking backward to predict forward.
Actuarial tables are built on the foundational premise that the past is a reliable predictor of the future.
The paper map analogy again?
Precisely. But when you introduce climate volatility, extreme weather events occurring way outside their historical frequencies, shifting floodplains, prolonged droughts affecting agricultural yield.
A baseline shifts.
Exactly. That historical claims data is effectively voided. It cannot predict future volatility because the baseline environment has fundamentally changed. So insurers are being forced to completely rebuild pricing models from the ground up.
Because if you use the old models,
If we use the old models, we underprice the risk and face insolvency when a cluster of unprecedented storms hits.
I see the direct parallel in banking when it comes to capital allocation and due diligence. I mean, we aren't just looking at the carbon footprint of a corporate borrower anymore.
You're looking at operational survival.
We're evaluating physical risks and transition risks.
Yeah.
If we finance a billion-dollar manufacturing hub in a coastal region, what is the physical risk of extreme weather shutting down their operations for 3 weeks? Or what is the transition risk if new international carbon regulations suddenly make their primary export economically unviable?
Because if their operations are disrupted or their product becomes obsolete, they default on their loans.
Exactly. Climate risk transforms directly into credit risk, which is why the sources assert that competitive advantage now depends heavily on anticipating change.
Being proactive, not reactive.
Right. Organizations that build adaptive capacity, the ones that can map these converging risks before they fully materialize, they will thrive. Resilience is no longer just a defensive posture, something you do to avoid a fine. It is a measurable competitive advantage.
But that's the tricky part, isn't it?
Here's where it gets really interesting. Because acknowledging that interconnected risks are threatening our portfolios is honestly the easy part. actually quantifying those risks across a massive global enterprise, prioritizing them and driving action, that is a monumental operational hurdle.
Yeah, how do you actually process that much unstructured data?
Exactly. And this is where the source stack introduces a specific technological architecture, Sophurion Horizon.
The materials introduce this as the flagship platform for a completely new market category. They call it Executive Predictive Risk Intelligence, or EPRI.
EPRI. It's a real paradigm shift in how enterprise data is handled. The text outlined a strategic evolution, right? Moving from data to information to intelligence to foresight to action and ultimately to resilience.
And traditional compliance software usually just stops at information.
Exactly. It tells you what happened. EPRI is designed to push executive teams all the way to action and resilience by synthesizing what will happen.
Let's dissect exactly how this works using the concrete example provided in the materials. We have an executive intelligence report here, dated July 2026, generated by the Horizon platform for an unnamed technology organization.
Right, it's a mock report.
It's a mock report, yeah, but it beautifully illustrates the mechanical process of translating raw data into boardroom strategy.
Let's open it up. So right at the top, the dashboard presents an overall intelligence score of 30 out of 100, categorized as contained. But immediately adjacent to that, it estimates the annual financial exposure at $595 million.
Which is a jaw-dropping number to put in front of a CEO. But what's crucial here is how it prioritizes that exposure. It doesn't just hand the executive a list of 200 potential problems. It ranks them by severity and probability.
Right. So for this specific tech company, climate is flagged as their highest exposure, scoring 43 out of 100. That actually ranks above supply chain fragility, which sits at 35 out of 100.
This raises an important question, though. How is it actually calculating that? I mean, we know humans can't read a million news articles and cross-reference them with an SAP database in real time.
No, definitely not.
So this is where the underlying mechanism of predictive intelligence comes in. The AI engine is constantly ingesting unstructured external data, global news feeds, satellite imagery reports, regulatory filings, macroeconomic indicators.
It's pulling from everywhere.
Everywhere.
Yeah.
And it uses natural language processing to identify patterns and sentiment. Then it cross-references that external data with the company's structured internal data, their supply chain management software, their financial ledgers, their facility locations.
So it's looking for correlations that a human analyst couldn't possibly spot at scale. Like, it might notice that a new water usage regulation in a specific province in India correlates directly with a manufacturing bottleneck for a key supplier listed in the company's internal ERP system.
Exactly. It synthesizes those disparate data points and calculates a probabilistic financial exposure. But, and this is vital, a score of 43 is just a number. The true differentiator of EPRI is bridging the gap between assessment and action.
Right, turning the score into a strategy.
The system generates prioritized, executive-ready recommendations based on those correlations.
Right, in the mock report, it breaks the actions down by time horizon. So for the short term, 0 to 6 months, the AI recommends convening a board review specifically on climate exposure, led by the CEO.
Very specific.
Very. And for the medium term, 6 to 18 months, it recommends embedding 2030 climate scenarios directly into the CFO's capital planning models. It assigns an owner and a deadline to every single action. It basically turns atmospheric risk into strict corporate governance.
But there is a specific nuance in this dashboard that I find absolutely fascinating from a risk management perspective. The report includes a metric called a confidence rating.
Yes, I saw that.
And for this particular climate assessment, the confidence rating is incredibly low. It's only 15 out of 100.
I noticed that too, and honestly, as a risk officer, it's the most transparent thing I've ever seen in an enterprise software platform.
Right.
Most tech vendors want you to believe their algorithm is this magical, omniscient black box. They would completely hide a 15% confidence score.
But Sophurion uses that low score as an intelligence tool itself. It's a feature, not a bug.
Exactly.
A 15 out of 100 confidence rating means the AI is mathematically identifying a sparsity in the data matrix. It's essentially telling the executive team, look, based on the fragmented data you've given me, here's your estimated risk. But to tighten these downstream recommendations, you have major blind spots that need to be addressed.
So it directs them on where to actually hunt for better data.
Exactly. It explicitly tells the organization to strengthen its lower confidence inputs. For example, it might highlight that the company has great data on its primary, Tier 1 suppliers, but zero visibility into the carbon footprint or geopolitical exposure of its Tier 3 suppliers.
So it guides the organization on how to become more systematically self-aware.
Yes.
And it is not entirely focused on mitigating downside risk either. I mean, predictive intelligence is also about identifying strategic openings. The report shows a 63 out of 100 opportunity score.
Which is huge.
It analyzes this tech organization's strong sustainability posture and calculates how they can convert that into a hard capital advantage. It suggests they can approach the markets for sustainability-linked financing to lower their overall cost of capital.
Oh, smart.
And leverage their low-carbon supply chain as a commercial differentiator to win massive procurement contracts against lower competitors.
See, that is the ultimate goal of resilience. Anticipating a structural market shift and capitalizing on it before your competitors even realize the rules of the game have changed.
Now, having this kind of synthesized dashboard is incredibly powerful for, a snapshot board meeting. But as a bank executive, my mind immediately goes to scale and latency.
The speed of it all.
Right. Global markets move in milliseconds. We cannot rely on human analysts manually uploading spreadsheets into this system once a month. How does this intelligence actually scale?
The roadmaps in our source stack address that exact scaling challenge by outlining a future integration architecture called digital-to-digital, or D2D, ecosystems.
Okay, D2D.
The vision is that Sophurion Horizon eventually functions as an active, continuous intelligence layer where enterprise systems communicate directly with other enterprise systems, entirely removing human data entry bottlenecks.
Wait, hold on. Stop right there. Because my compliance department would have an absolute heart attack over this.
I figured you'd say that.
I mean, if you are telling me we are taking human executive judgment out of the loop for banking and insurance risk assessments and letting systems execute decisions based on an AI's probability score,
it sounds risky.
that is a massive regulatory liability. I cannot walk into the OCC or the SEC and say, well, the algorithm decided to dump $1 billion commercial real estate portfolio because of a data blip in the D2D feed.
And that is an entirely valid, critical concern. The texts are very explicit in addressing this exact fear. They clarify that the AI is not the product. The AI is simply the analytical engine.
Yeah.
Executive Predictive Risk Intelligence, EPRI, is the product. The D2D integration is designed to synthesize the data instantly, but it is explicitly architected to augment executive judgment, never to replace it.
Okay, you need to explain the mechanics of how that boundary is actually maintained.
Sure. Think of it as an intelligence funnel. Imagine integrating your customer relationship management software, like Salesforce or HubSpot, and your enterprise resource planning systems, like SAP or Oracle, directly into your financial risk platforms via API. The AI continuously monitors those massive live data flows. Let's say it identifies a subtle pattern indicating a geopolitical shift is about to choke off a critical mineral supply needed by a major sector of your commercial borrowers. The system doesn't automatically alter your lending rates. Instead, it pushes an actionable, synthesized intelligence brief to your executive dashboard in real time. It does the heavy lifting of reading the tea leaves across 1 billion data points. You make the strategic call on how to actually adjust the portfolio.
So it serves up the probability heat map, but the human still decides where to move the chess pieces.
Precisely. And Horizon is really just the starting point of this architecture. The documents outline a broader, integrated ecosystem of intelligence platforms designed to talk to each other.
Right, I remember seeing that. Horizon serves as the flagship executive layer, but it will integrate with future specialized modules.
Right.
The texts mention Shield, which is a platform designed specifically for insurers and risk managers to evaluate underwriting risk and portfolio resilience at a granular level.
Which I'm very excited about.
I bet. Then there's Atlas, for continuous global geopolitical monitoring and strategic foresight, and Terra, which focuses heavily on predictive environmental intelligence and infrastructure resilience.
So by linking these domains together, banks and insurers finally get a holistic 360-degree view of systemic contagion.
It creates a central nervous system for organizational risk.
That's a great way to put it.
So what does this all mean? If you are sitting with us, looking at this data, the takeaways are clear. The financial and operational risks we face today are irreversibly interconnected. A cyber threat is a supply chain threat, which is a financial threat.
They are all the same thing now.
Relying solely on historical data and static compliance auditing is a dangerous vulnerability in an environment where the baseline is constantly shifting. Emerging risks develop far faster than traditional systems can detect them.
Yeah, you have to look forward.
But by adopting predictive AI intelligence, we can move from simply reacting to disruptions to anticipating them, making organizational resilience a measurable competitive advantage.
And if you are an executive trying to guide your organization through this age of convergence, the sources offer two very clear, practical next steps to bridge the gap between theory and action.
What's the first one?
You can request an enterprise demo to see exactly how your organization's currently fragmented data can be ingested and transformed into this kind of actionable, prioritized intelligence.
Or you can book an executive intelligence review to explore your specific resilience gaps through a focused, high-level consultation. It is entirely about finding out where your blind spots are, identifying your 15 out of 100 confidence scores before the open market finds them for you.
We have spent the last 50 years, and honestly billions of dollars, building incredibly sophisticated financial and insurance systems perfectly designed to tell us, with flawless accuracy, exactly what happened yesterday.
But here is a final thought to mull over, one that really stretches beyond what's written in these documents. If platforms like this become the gold standard, we are entering an era where the most powerful financial institutions are all utilizing predictive AI to map tomorrow's interconnected risks.
Right.
But what happens when every major bank and insurer is looking at the exact same predictive heat map?
Oh, that's a chilling thought.
Right. If an AI flags a converging risk in a specific sector, and every institution simultaneously acts on that intelligence by divesting capital and denying insurance,
It creates a self-fulfilling prophecy.
does the predictive intelligence inadvertently trigger the exact economic crash it was designed to help us avoid?
Wow.
How do we balance anticipating the disruption without accidentally becoming the cause of it?
Wow.
Is a fascinating challenge for the next decade of finance.